You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right. Real Estate Runway family, welcome to another episode of Real Estate Runway podcast. This is the special Chad's Soapbox edition. I know I've been very sporadic with doing these. We're going to do more, I promise. But let's get into a topic that's very near and dear to my heart, and that is the type of property that Team Quattro chooses to buy today. Why we buy Class B assets that have the ability to participate in the Class A upside. So before we get into the meat of the episode, folks, if you get any value out of this show, we put a lot of effort into it on your behalf. Please scroll down, give us a 5-star review, give us a thoughtful comment. It really helps this message get to more people. It helps the show grow. It helps us reach new audiences. Please share the wealth just like we're doing to you. 5-star review and a thoughtful comment. Thank you for your participation, your patronage, and everything that you, the people, do for Quattro Capital. We are all about the people, all about the investors, all about the people that we benefit in this life. So thank you to all of you. All right. Now, getting back into the context of what it is Quattro Capital buys. Now, I'm recording this in about late September 2022. So the current environment is we have had 7 rate hikes at this point. The last 3 were 75 basis points. So we're in the rising inflation market. We're on the tail end of a huge bull market that we've had in the last 10 years. And we're still buying property. Why is that? Well, folks, good investors buy all the time. We might change the strategy of how we buy, but we're always buying property. We're always acquiring assets, and we're always selling assets when it makes sense. Why are we buying Class B assets? The main reason is the type of resident that they attract and the income level of the resident they attract. So at Quattro Capital, we have owned everything from Class D assets, which would be categorized as high crime, war zones, but they will come with the ability to make a lot of money on an upside if you can get them to a good operational status and really infuse a steep value add. We have operated Class C properties, which are a little on the older side, mostly blue collar workers, maybe some higher crime as you move down the scale a little bit. And we've also owned Class B assets. We've even owned some low end Class A assets that we have right now. So we've really owned pretty much everything in the spectrum that you would consider on multifamily quality, if you will. Okay. Let's talk about 3 pillars here. One is the physical asset itself. One is the area that asset finds itself in. And one is the type of resident that typically will live in that area. Okay. So now in the time that we're in, let me first preface with this. In the time that we are in, we are no longer in the massive expansion cycle that we have had. We are at least experiencing a debt downward cycle and a negative trend in the capital markets. The jury is still out, depending who you ask, on if we are actually in a recession, if one is coming, how severe it will be. I'm not here to debate that. What I am here to assert is that when a massive deleveraging happens, or when capital markets and debt markets start to move into decline, when asset prices may start to fall a little bit, if they start to fall, or when jobs may start to be lost in an economy, typically the first people to be hurt are the low income wage earners who are barely making ends meet as it is, right? On the other side of the spectrum, typically, if unemployment gets severe enough, you will start to see that people who we would consider our Class A or luxury tenants, renters by choice, mostly white collar to, just plain renters by choice if they even have a job, they will be typically the type who are, if they go into a job loss scenario, they're going to be moving downward and looking for something with lower cost rent. Okay. So if we look at the two ends of the spectrum here, Class D and Class a Class D property being, from a physical perspective, it is really old. It is really old. It's in a deteriorating part of town, and it is typically, you know, housing the lowest of the low income. Okay. And actually, I lied. We're going to go up the scale. Going to Class C, you're still pretty old, maybe not functionally obsolete yet, but you're probably, it's going to be to the point where units are smaller. Maybe you don't have washers and dryers. Maybe you have obsolete amenities, but it can still be a decent home as long as you can, mitigate things like the physical aspects of plumbing, electrical, just the old obsolete infrastructure that has been put there. You move into the Class Bs, those are typically just a little bit old. They're maybe not built in the last 20 years, but they're still going to have decent plumbing, decent electrical, decent roofing, decent structures, decent windows, and they're typically going to attract, if they're well kept, a mixture of renter by choice and renter by necessity. And then of course you have your Class A properties, which this in my opinion is a wider array. Class D is very small, Class C is very small, Class B is a little bigger, and Class A is wide, because you really have like the brand new builds, the ones that are just right off the manufacturing floor, if you will, to ones that are maybe 20 years old. So when you're looking at the quality of an asset, we no longer buy, and we haven't for a long time, anything that is brand new. Brand new, there's just, low risk, low return, right? That is when they come off the manufacturing floor, so to speak, you're going to be paying the most amount of money that unit will ever be worth, likely. And you're really going to be minimizing the cash flow you can buy for the given dollar. Now, institutions with lots and lots of money and low equity growth obligations will buy these because they're low headache. There's really nothing that can go wrong as long as you get your income projections right. Okay. But then we go back and look at Class D buildings. Those are really going to have functionally obsolete units. They're going to have inadequate kitchens. They're going to be falling apart. They're going to have cast iron. They're going to have galvanized plumbing, aluminum wiring, like things that we just don't do anymore. Okay.
Have you heard about the Multifamily Investor Nation Summit coming up on January 20th? If you've never been, it's a 3-day information packed event for multifamily investors with over 1,000 attendees and over 50 speakers. Not only will you hear from experts about finding deals, raising capital, underwriting strategies, selecting markets, and so much more, but this year, our partners here at Quattro Capital are excited to be participating with 3 speakers at the event. Our amazing Kim Wendland will be speaking on the often neglected subject of asset management, how to make the machine hum. While our most interesting man in real estate, Maurice Philogene, will be speaking on how to leave your corporate job for a freedom lifestyle. I personally will even be speaking on the topic of how to perform due diligence on multifamily assets before you purchase them, and the not so common things to watch out for. Go to mfinsummit.com to grab your ticket and use promo code Quattro to get $100 off of your full access pass. Whether you are new to multifamily investing or a seasoned investor, you do not want to miss this event. Join Team Quattro at the Multifamily Investor Nation Summit. Visit mfinsummit.com, promo code Quattro. That's mfinsummit.com, promo code Quattro.
Those physically are assets that we just don't want to hold. We get into Class C assets where you have a little mixture of this stuff, but then we get to the happy medium of a Class B asset where your infrastructure is good, you have good wiring, good plumbing, good electrical, mostly good roofs, good windows, good structure, and you're usually getting to spend money where it counts on interior, interior finishes and things that will drive your rent to increase. Okay. Now let's back up and talk a little bit about the resident or the income level that you wind up catering to in each of these assets. In a Class D asset, you're usually going to be high crime. Income level is going to be low, if non-existent. And so you really can just expect massive delinquencies. You can expect drug activity. You can expect other illegal, we'll just say businesses being run out of the units. And you may even be in a part of town where police are just not willing to help you because, they want to go home at night too. So if you know how to run those things, those can be very good from a cash flow perspective. but it's a very limited buying pool for that. So it's a relatively illiquid asset, and you're basically buying something that is functionally becoming obsolete. It's becoming a trash asset. And so in the times that we're in now, it's not the wisest cash flow stream to buy, simply because when we get into a recessionary or any sort of a negative growth time, or even anything with job loss associated, or affordability issues, that is the resident base that struggles the most. Okay. Moving into Class C, it's kind of equivalent. You have a mixture of crime, but now you're starting to introduce a lot more of the low wage earner jobs. And unfortunately, those are the individuals who are impacted the most by things like inflation. With their fixed expenses going up, their variable expenses going up, you're finding things like, their jobs are going to be the first to go when companies start cutting back, because those are, quote, expendable jobs that can be easily hired back tomorrow with anybody else willing to work. And so you're really setting yourself up in a time like this for a very volatile cash flow situation. So you might be able to show on a pro forma that that's a 30 IRR deal you're looking to buy, that's 1972 build and all that kind of stuff. But there's a few things we could name that could go wrong that could make that a 2 IRR very quickly. Things like a plumbing malfunction, things like having to dig up pipes out of the ground that are popping because the water meter is pushing too much pressure, and therefore your galvanized pipes can't take it anymore. Things like half your tenant base being laid off because a factory closed nearby, or anything of that sort, right? So moving into Class B, this is really a happy medium, because you have a mixture of people who are renters by choice and renters by necessity. We've always heard the old adage that people move up into these when times are good out of Class C buildings, and they move down into these out of Class A buildings when times are not so good. Our hyper-focused value-add business plan is to take these Class B assets and create an interior product that is comparable and will compete, not beat, but compete in most cases with Class A product. And therefore, you really you have a lower basis asset where you've paid less money for it, and you wind up catering more to a higher income resident base than what that asset is typically used to. And so that's a sustainable value add that is really good when cap rates are on top of each other, i.e., I'm paying the same cap rate for a 1960s build as I am for a 2000 build. Why am I buying a 1960s build, right? They're functionally obsolete. They're not going to be a long-term asset if I have to hold something for the next 15 years and cash flow it while we go through a recession or something of that sort. So, think about that when you're making your investment decisions today. It is not always about IRR. It is not always about annualized rate of return. It is not even always about cash flow, because if you stack two assets together and you look at a Class B or a Class A asset, preferably a Class B, because you're probably going to be able to buy that a little bit better and put a little bit of value into it. If one is showing a 6% cash on cash return and one is showing a 12, i.e. probably the older property showing a 12 because you hopefully can buy it better, or hopefully they're showing some sort of value add. The problem is the number of things that can go wrong are just too paramount, that there's too many of them to allow your risk-adjusted return to keep those numbers where they are. What's really going to happen is if you start to adjust your risk-adjusted return, your 6 is probably still going to stay between a 5 and a 6, and that 12 could drop to a 3 or something of that sort, because there's so many things that are unpredictable that can go wrong that are out of your control. So anyway, that is just a little segment on why Quattro Capital is focused on buying Class B assets that we have the ability to compete with lower end Class A assets after renovation. We are pushing for a higher income resident base. We're pushing for low crime, and we're pushing for infrastructure that is not functionally obsolete, floor plans that are not functionally obsolete, things that will stand the test of time, things that we can hold for 5, 7, 10 years if we have to. Because folks, the only way you lose money in real estate, the only way, mark my words and ask me how I know, the only way you get in trouble in real estate is you run out of time or you run out of money. Okay. You do not want to buy money pit assets right now and you do not want to buy assets that can wind up going into severe negative cash flow, due to a susceptible resident base that may cause you to lose that property because of, defaulting on a loan, or, just getting behind on your general pro forma, and having to refinance or sell when you don't want to. So time and money are the two things that buy you health and happiness in real estate. Until next time, folks, I'm your host, Chad Sutton. We're powered by Quattro Capital. Again, if you like this episode, please subscribe. Please leave a review. Please leave a thoughtful review below and all that good stuff. So until next time, this has been another episode of Chad's Soapbox on the Real Estate Runway podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.